August and February. It means that trading is quite risky, dangerous, so people always care about how they should invest. And all the literature on market booms and crashes only about market crashes, because if you have a market boom, then you always think it's okay. So if you make money, you think it's good, but it's okay. But if you lose money, it's always in the news. So all the literature on sorry. All the literature is on market crashes, um, and there are basically 5 different groups of models for market crashes. And I want to briefly describe the main idea behind each group of models. So the first group of models is called temporary reduction in liquidity. And the idea is that sometimes we have a shortage of liquidity and the price plummets just for no reason, but just we have this liquidity issue. The second group of models, they are called multiple equilibria and sunspot models. The idea for this type of models is the following. We have multiple solutions for the equilibrium price, and sometimes price might change its equilibrium level without no fundamental reason at all. So we just move from one equilibrium to another. And sometimes it happens due to some sunspot process. Sometimes we just have to move, but the basic idea is that we have several levels for the price. And the third group of models, it's very famous. There is lots of literature for this group of models. It's called bursting bubble. So the idea is that all the agents, they know that there is some overpricing. So they know that the actual price is greater than its fundamental value. And this bubble, it grows, and at some point it bursts. But the idea is that it's common knowledge that we have a bubble, but we don't know when it should burst. So we think that we are smarter than other people, so we just keep buying some asset, and at some point the price plummets and we have a market crash. And the fourth group of models is called lumpy information aggregation or informational cascade. So the idea for this group of models that it's not a common knowledge that we have overpricing, but at some point we get some additional information, and then this the small signal will give us an idea that we have overpricing. So this signal comes at some random time, and then in this case all the agents, they combine this information with all the past price dynamics. They will realize that we have overpricing, and then we have a correction for the price. And the last group of models is based on recent papers by Kyle and Obizhaeva. It's in 2011, 2012. It's just quite new approach. It's based on market microstructure invariance. And the idea is that if we have large bets on the market, then if traders, they want to execute it too fast, just faster than the natural speed of execution, then we would have a market crash. And in my talk, I want to concentrate on the second group of models that are called multiple equilibrium models. So all these 5 groups of models, they have different nature. So if I talk about burst and bubble models, it would take 2 or 3 hours. But I want to talk only about this multiple equilibrium approach. And my PhD thesis is based on how we can model this in continuous time framework. And the problem I had is just that I could not find any other papers based on multiple equilibrium modeling in continuous time framework. But I received an email that we should not talk about single papers. So what I decided, I will talk about all the models that I analyzed in my thesis, but I don't want to go to the details. So in this case, I think it would be fair. So I will not talk about this only one paper. I will talk about different models. But the idea is the following. We want to model how the price can change different equilibrium levels. So the idea is that it stays at some equilibrium level, and then at some random point in time, it just switches to another regime. And then when we have this switching from one regime to another, we have a jump on the market. So as a consequence of this, we have multiple jumps. So we have both booms and crashes. So in this kind of modeling, we don't differentiate just between booms and crashes. So we can have both booms and crashes. So booms, these positive jumps, and the crashes, they are negative jumps. And we model it in continuous time. So all the research that was done for multiple equilibrium models, it was only for just 1 or 2 periods. But what we can do is just we can do that in continuous time framework. And I will talk about the different examples of models. This is just an example because we can have absolutely different structures of how we can change equilibrium levels. And I will explain how all these 3 models they work. And the difference is just only how we can model the switching mechanism to switch from one equilibrium level to another. And how we can do that, we will talk about just like market microstructure framework. So it's always how we can define the price. So price is determined according to the law of supply and demand. And what we can do is the following. If we have a continuous time framework, we have some time horizon from 0 to t when we have the trading. And then since we want us to model it using a theoretical approach, then we should assume, so we should have some assumptions. And these assumptions, they are just only to simplify the solution. But the approach can be extended to any assumption that makes sense. So I want just to talk only about just how we can do this quantitative modeling. And here we just assume that we have no information asymmetry at all, so all the agents, they observe the same information. And if we want just to model jumps on the market, just we should assume that we have some assets. And so here in this example, we have just only 2 assets in the economy. Just we can put the money to the bank that offers some interest rate R that is risk-free, and also we can put the money to the stock, and the stock price process is risky, so it's stochastic. And for risk-free bond, we can assume that it grows with the rate R that is greater than 0. And we assume that risky stock is in 0 net supply. And if we want us to do modeling, we should make some simplifications just to make the model solvable. And the idea is that all the agents, they can observe past price dynamics, and then they would approximate future price dynamics based on what they observed in the past. But of course, they should believe in some price dynamics. Because if they don't believe that it's going to be like what they observed in the past, then they should make like proper corrections. And they approximate the future price dynamics with some process that we call small pu. So capital Pu, this is actual price, and small pu, this is what they use for this approximation. And then if you want just to do modeling, then you should assume that you have like different groups of agents. And in this example, we have only 3 groups of agents, but as I said, you can incorporate any type of behavior. But why do we have these 3 groups of agents? But first, we want to make it as simple as possible. But if you want to make it as simple as possible, but such that it should satisfy some conditions. And if you want to have multiple equilibria framework, you should assume that you will have different behavior for agents. Because if you have, say, just only one group of agents that have the same behavior, then we all know that demand and supply, they are monotone functions, so the price will be determined according to the law of supply and demand, so we will have unique intersection of monotone functions. But if you have agents that have different behavior, then we might have some non-monotonicity. So how can we model that non-monotonicity? We assume that we have 2 groups of agents that have different behavior. So the first group of agents, they are just rational investors. And if they are rational investors, they just want to maximize the expected utility. And they always just rebalance their portfolio according to the information that they observe. And if we have the second group of agents, their behavior is absolutely different. And they are dynamic hedgers. So why we have dynamic hedgers? Because, say, if we are talking about the crash of 1987, we know that many people, they blamed dynamic hedgers for this market crash. So we had many algorithmic traders that just wanted to replicate the payoff structure of some instruments like put options, call options, and that created the condition for the crash. And the most famous paper that analyzed that crash dynamics was the paper by Janot and Leland. And this research is based on that paper. So what we wanted to do it in continuous time framework. And here you can see that the second group of agents, they are dynamic hedgers. And how can we model this multiple equilibrium? We can see that the first group of agents, the component of demand is decreasing function of the price. So if price increases, they want to have less number of shares of this stock. And the second group, they are dynamic hedgers. They just replicate the payoff structure of some instrument. And if these 2 components, they work in different directions, so the second one, if P increases, then the component of demand increases, then we have non-monotonicity. So how can we model this non-monotonicity? There is lots of room for extensions, but the idea is that these 2 components, they should work in different directions. And if you want to make this model stochastic, then we assume that we always have some noise traders who trade for no reason at all. So they just create some noise and they make the behavior stochastic. And if they make this behavior stochastic, we have all the components. We have the model as simple as possible, but at the same time, we would have this multiple equilibria. So what we have for pricing equations is summation of all these components should be equal just to the net supply that is equal to 0. This is just assumption. And then what we might have is just, we can have the pricing equation that will be some function of time and price is equal just to Brownian motion. So this is how we can rewrite it. And what happens in this case is that if we have some non-monotonicity, then this function h will be non-monotone. And the price will be determined according to the condition that this function is equal just to the value of Brownian motion. And on the left-hand side, what we can see that if the number of dynamic hedgers is 0, or if it is small, then we don't have this non-monotonicity at all. So in this case, we don't have multiple solutions. And how can we model this multiple equilibria? We know that there is a problematic region where we have 3 intersections for this curve and the value of the Brownian motion process. Sometimes what might happen is the following. We move just from one equilibrium to another, and there is no fundamental reason at all. Or what we might have is the following. So Brownian motion, it's in this problematic region where we have 3 intersections. So the first branch, like the one that is increasing, it corresponds to low levels for the price. Then this curve, it starts decreasing. We call this medium level price. And when it starts increasing, we call it upper level price. So in this case, we have a large value for the price. So sometimes we might jump just no fundamental reason at all, so we jump from one level to another. But sometimes we have some reason for that. So assume that we are on the right branch that is increasing, so we have a big value for the price. And then at some point, the Brownian motion, it starts decreasing, and we can see that in the bottom, we have only one intersection. So what we have, just we are pushed to jump from large value to small value for the price. And in this case, we would have a jump. And this might explain what happened in 1987. So just no reason at all, but we have a jump. So this is what was done in the paper by Janot and Leland, but there are many papers that use this multiple equilibria framework. But this is just generalization of this behavior to continuous time framework. And we might do modeling of how it happens. So we have, say, several models, but you can extend this approach just to any kind of behavior as you want. So according to the first model, just we have some Brownian motion path dynamics. This is something random, and then we know that we will have a jump if we go like from low level equilibrium to upper level equilibrium. So when we hit one of these boundaries, either green line or blue line, but at the same time, we don't want to have infinite price oscillation. So the jumps, they occur quite rare. So just it's not like 5 jump times in 5 seconds or in 5 minutes. So we have that the price stays in some level, and then at some point it jumps. So we have the different mechanisms of how we can have it. So these mechanisms, they are based on some sunspot parameters. So say, if you are talking about this exogenous shocks model, so what we have is the following. Say, assume that you have some news process. So this news process might be, say, elections in some countries, or there might be some bad news, some good news. And then what we have is the following. These elections or these bad news, they come at random times. And then we can model it. So once we have this bad news, we might have 2 different scenarios. According to the first scenario, we have to be in a good equilibrium or in bad equilibrium. But if we are somewhere in between, in this problematic region where we have three solutions, then say we might have elections in some country and this result is very bad. Then no fundamental reason at all, but we are pushed to jump. And you can model it just according to two different techniques. So the third one is just we have stochastic number of dynamic hedgers. So if we have that the number of dynamic hedgers changes, so we have, say, new player comes to the market, and then they start replicating the different instruments, then we might have another jump. So what we can do, just we can model how price jumps like from one level to another according to all of these mechanisms. And then the problem with all these models is that price might take negative values, or we don't have solutions in closed form, so we can do this just in alternative format. So instead of using market microstructure framework, you can specify the pricing equation. So you can assume that you have some model that would look like the original model, but that would have nice properties. And these are the alternative models. So we might use this financial engineering framework. So I think that's it for my presentation. I just wanted to be quite concise. I don't want to talk about all my models because it would be a presentation for my research. But what I wanted to do, I just wanted to give you the idea of how you can model jump behavior. So this is basically all the results that I have, but I will not go to details because, as I said, it's not my presentation. It's a presentation of all the models that we have. And I would be happy to answer the questions.
I think this is very interesting in the higher frequency realm, where a lot of market makers act as if they're short. So they're basically buying, selling, and building up inventory, and then trying to move markets or move their quotes so that they get done. But at some point, they have an inventory, the market moves against them, and they're basically trying to hedge that and roll the puke out of the position, as it's called, if it gets too large. And there's quite a lot of people doing that. And so in the shorter term time frames, I think there's a big effect here of those people who act as if they are short an option.
Because this framework can be applied for short term, for long term, for different markets. So if you incorporate like different types of behavior, so this is just explains how it might happen. So sometimes we have no fundamental reason, but we have like different investors that exploit like different strategies.
Another question?
Another one from me. I think this agent-based modeling is very interesting. Another way of getting a similar kind of instability is to delay information for some of the actual players in your agents. Some agents see up-to-date information, some agents see information from a little bit further behind, because markets full of people working on very different time frames. There are the super high frequency algorithms that you were talking about, and then there's people who kind of trade on a minutely, hourly, daily. Some pension funds sort of woke up about 2 years ago and went, oh look, the price of oil's gone up. It's that kind of, there are people working on very different time frames, and that might give quite interesting dynamics.
But the main problem was just we want to get some formulas. In this case, we have to simplify. But it's just all the assumptions, they can easily criticize them. But what we wanted to do, we wanted just to explain how it works, just to explain the nature. But for trading, of course, we might have like different time horizons, different behavior.
Any other questions? Thank you for a high frequency talk. We have actually we're ahead of time now, so